Hello guys, I hope you and your families are doing very well. Jack Corsellis here. I'm going to give you a warning at the start of this video. It is going to be an extremely in-depth video on risk management. I'm going way down into the weeds. I think this is going to be the most in-depth video you have ever seen on risk management, especially early on when you are trading breakouts from VCPs, from cup and handles, from flags, from Darvis boxes. So I'm going to break this video into two parts. I'm going to first off start off with this schematic, which is a VCP. We're going to be talking about the main concepts that I want to teach you in this video, and then I'm going to show you my current 5 open positions, all of which are free rolled, and I apply the exact same tactic strategy that I'm going to be teaching you in this video, so you can see actually how am I doing this with my own trades, how am I managing them. So the principles that I really want you to take away from this video, I cannot sum it up better than Sun Tzu said in his book The Art of War, which I'm a very big fan on, especially if you relate it back to trading. The good fighters of old first put themselves beyond the possibility of defeat and then waited for an opportunity of defeating the enemy. Another one which is very key: invincibility lies in the defense, the possibility of victory in attack. So I will be linking those quotes back in to trading. So let's get into it. I'll give you an outline of what it is I'm trying to teach you in this video, then we'll start going into the weeds. So you can clearly see here a VCP, which is the blue line. Okay, so what I'm saying here is price goes up around about 30%. We have 3 contractions in the base. Contraction 1, 12%, rally. Contraction 2, 6%, rally. Contraction 3, 3%. So the contractions are halving in depth each time. That is a very healthy sign that you're looking at a constructive VCP. The black line is the 10 EMA and the blue line is the 21 EMA, and we're going to say that the pivot is $200 right on the screws. We're then going to be looking at potentially 2 stop losses, one at 3%, which is underneath the third contraction, which is also underneath the 10 and 21 EMA, and then one underneath the second contraction, which is going to be 6%, which is also roughly underneath the 10 and 21 EMA as well. Now we're going to talk about free rolling as well, which you've probably never heard this spoken about, whether you've read the Minervini books, the Darvis books, the Weinstein books, the O'Neill books. You've probably never heard about it or seen it explained like this. So what on earth is free rolling? So if you are trying to free roll a position, what does that mean? It means for me that I'm trying to take all of the risk out of that trade. Now there are 2 ways to do that. Option number 1 is you can simply move your stop loss up from wherever it is to break even on the position. Of course you can get gap downs, you can get slippages, but just understand the main points that I'm trying to explain here. So one way to do it is you can just move your stop loss. So say you went in with initial risk of 6%, you then just place your stop loss break even, so on $200 in this instance. Another way, which I think is much more effective, and it's what I do myself, I sell part of my position into strength at certain risk multiples of either my initial stop loss or my new stop loss. So let's start talking about that. So levels to free roll. If you wanted to free roll, and I'm assuming that your initial stop loss and or new stop loss is in single digit percentages, okay? If you're taking if your stop loss is 25% or 33%, losses work geometrically against you, so it is not going to be applicable these levels. So I am assuming, okay, we will have to apply a little bit of common sense rule, big boys and big girls. I'm assuming that your stop losses are single figures anyway. So what are the levels to free roll? So let's just do some hypothetical examples. Imagine you target the breakout here at $200. You get filled very close to that pivot point, and you place your initial stop loss here at 6%. If the stock gets out 6%, then you could sell half of your position to free roll the trade. Okay, so you are locking in half of your position at 6% gain. Your remaining stop loss on the other half is 6% as well, so you are break even on the trade. Now if you did not want to sell half of your position and you wanted to sell a lesser amount of your position, you could sell 1/3 at 2 times wherever your stop loss is, or you could sell 1/4 at 3 times where your stop loss is. So you're probably a little bit confused, so let me start talking about it. So let's assume you target a breakout here at $200. Remember, I've got 5 examples of trades that I'm actually long at the time of filming this that I'm going to show you, so you can actually see how I'm applying this to my own trading a little bit later on. So let's assume you target a breakout here at $200 and you see, well, there's 3 contractions in this space. I'm going to place my initial stop loss underneath contraction number 2. That's underneath the 10, the 21, maybe the 50s in there as well. I haven't put the 50 SMA on because the chart will get very messy very quickly. So you place your stop loss here. Okay, so you have a 6% stop on the position, and if you're swing trading around breakouts, your average stop is probably going to be somewhere between 3% and 7% for your initial stop loss. That is probably where you're going to be if you're trading VCPs, flags, high tight flags, Darvis boxes, cup and handles. 3%, 7% is roughly where you're going to be. So you place your initial stop loss here at 6%. Now the trade starts moving up. Okay, so the trade starts moving out. So I'm actually going to draw this in, let's draw this let's do it in orange so it just stands out. So imagine after this, okay, you get fill. Now the trade starts doing this, has kind of a little test in here. Now it starts powering up. So we're now speaking about this moment in time now. Now, if any of you guys have played sport at a very high level, you will understand the key to being very good at sport, whatever sport you're playing, is the ability to adapt to changing circumstances. Now, in the market, you always have changing circumstances. Second by second, when the market is open, price is changing, volume is changing, relative strength is changing, price is going up, price is going down, this group's moving, now suddenly this group isn't moving, this group's over here is going, change of characters happening there, bullish synchronicity breakouts over here, this group is setting up. You have to be able to change. Now, especially early on in your positions, my objective is not to try and make a shed load of money. My objective is, Sun Tzu quote, position myself beyond the possibility of defeat. Now, I would add when prudently possible. So when prudently possible. So let's say you take the entry here around $200. Price now powers out this orange line, and we're now here where this blue arrow is. So the share price now is $212, nearest damn it. Let's just make the figures really round here. So it's $212, okay? So it's got out around about 6%. So it's now up 6%, and your initial stop is down here. So you now do have an opportunity to free roll the trade, position yourself beyond the possibility of defeat. How? Because you could sell half of your position at 1 times where your stop loss is. You could sell about that. If you want to go and open up Excel and work all this through, you absolutely can. I don't want to make this an hour-long video, but these are the levels to keep in mind. So you could sell half of your position at this 6% gain, and then your remaining shares are free rolled. So if price then did this and came back down like this, and you got stopped out here, down here, you'll break even on the trade. So the stock has done no damage to your account equity line. That is what I'm looking to do. Position myself beyond the possibility of defeat. Free roll the trade, I call it. This is active risk mitigation. Or you could go, the share price is now $212. I have my initial stop loss down here at around about $188, so around about 6% roughly. Okay, you could go, price is now up here at $212. There was a third and final contraction in this base. I could move my stop loss from 6% up here underneath this third and final contraction before the breakout, which is underneath the final contraction. It's underneath the 10 EMA, it's underneath the 21 EMA, and if we were to just draw, say, the 50 SMA, okay, maybe the 50 SMA is like this, okay, you could go, and let's just make that purple. So you could go, I could move my stop loss up, so push it from 6% to 3% underneath this contraction, underneath these 3 key moving averages, and now I could sell 1/3 to free roll my position. So in here I could go 1/3 to free roll. Interesting, right? So you have options, especially very early on in a trade. Now, I'm an intermediate term trend follower, so my objective is free roll the trade and try and sit for the intermediate term trend. I have no idea whether that intermediate term trend is going to be 5%, 50%, hundreds of percent, or if I'm going to get stopped out in a couple of days, a couple of weeks. I have no idea. I am there for the intermediate term trend, but the intermediate term trend, I have no effect on it. Okay, it is a numbers game. It's variance based, trying to position myself in front of high quality opportunities and just do it over a large enough series, and then take very kind of asymmetric risk versus reward trades. Look to mitigate that risk very quickly early on in positions as well, in case it is kind of pop and drop back round. I free rolled the trade. So instead of then coming out with a 6% stop, a 4% stop, a 3% stop, or whatever it is, I'm coming out the other side break even where possible on my losing positions, and then not losing kind of trades because I'm trying to come out break even. Hopefully you're understanding the point. So you have an option here. Okay, if the share price is at $212, do you want to be trader A, who has their entire position but they still have open risk on the trade of 6%, or do you want to be trader B, who goes, I'm going to sell 1/3 of my position, push my stop loss up here, now I'm break even on the trade. So if price then comes back down here like this, and let's change that back to orange, I'm break even on the trade. Which trader do you want to be? You have a choice. You have choices in terms of how do you want to manage your positions? How do you want to manage risk? How do you want to actively mitigate risk? How do you want to free roll trades? You may have never heard about free rolling trades. This is how you do it. I'm going to show you how I do it in my own trades as well. So you have choices. So do you want to wait until price gets all the way up here to potentially $224-ish before you free roll at 2 times your initial stop loss? Or as the trade is playing out, do you adapt and you go, hang on a minute, I have a prudent opportunity to mitigate all the risk on this trade? Now, some of you may be saying, well, you should have just gone in with initial stop loss of 3%. Trading is not this clean. It is a messy affair. Okay, it is not textbook. Trades play out in different manners. Sometimes you have to be quick. You'll see a biotech stock that I was able to free roll, but the share price actually ended up with what I call a large supply supply shoot where price goes up, comes back down. So by the end of the day, the stock is only up a couple of percent, but I was able to free roll at a higher price because of this active risk mitigation. So you'll see that as we go through. Also, the initial stop loss, for me, it doesn't determine necessarily where I'm going to free roll the trade. It just determines where is the point I'm getting out, what is the maximum amount of risk I'm willing to take on this trade. It does not necessarily play the effect in terms of the active risk mitigation. Why? Because the trade plays out. But on a setup like this, I could be going in and going, yeah, initial stop maybe around 6%. Say this isn't a kind of a VCP that goes up 30%. Maybe it's a it's a flag type pattern that's gone up 75%, 150%, and now it's tightening up. I may want to give it a little bit more kind of width, if you want, in terms of my stop loss early on in the trade. But then suddenly, as the trade starts moving out, that is when I want to be very active in terms of the risk mitigation. Go, okay, and I'm thinking ahead here. I'm thinking steps ahead and going, okay, initial stop here, but I'm likely to be pushing my stop loss there. So then I could have a sell limit order into the market up here. That means I could sell 1/3 there, and then simultaneously I'm pushing my stop loss up on the remaining position. Great, free rolled it. Can I now sit through the intermediate term trend? So you may have to watch that a couple of times. I appreciate it. It's you've never heard about any of this in the books in the books you've read. You certainly haven't seen it explain like this. So let me show you my current open positions. So here we go. Let's load this up. So first ones are a couple of solar stocks, right? So this is Enphase Energy. Yeah, I think solar, it looks extremely interesting. So this is Enphase Energy, right? So my entry is in here. There's this nice shakeout to Martell here, perfectly undercuts a 10 EMA, low volume. So my entry is here. My initial stop loss is then placed underneath the low of this Martell. Now on Enphase Energy, it's coming out of this cup and handle. On the daily chart, there's a big wiggly base, there's a massive monthly base. It looks really strong. Solar looks really strong at present. So my entry is in here. So my initial stop loss is placed underneath the shakeout to Martell, which is also underneath the 10 and 21 EMA. So my initial risk on the trade is 4.38%. However, price starts moving out on this day here. So on this day here, I now have an opportunity. So again, I'm thinking trader A, trader B. Who do I want to be? I have opportunities here. When the trade starts moving in my favor, it opens up doors of possibilities for how do I want to manage that. Now, early on in the trade, I'm trying to mitigate risk. So there are 4 parts to a trade. There is identify, there is initial controlling risk, there's risk mitigation, and then there is optimizing the profits. So we are heavily focused here on that third part, which is the risk mitigation, free rolling trades. So on this day here, what do? Well, I go, I can move my stop loss up from here. I can push it up. Now my stop loss is now placed on the position at 299.47. So I'm still underneath the psychological round number of $300. I'm underneath the 10 EMA, I'm underneath the 21 EMA, and I free rolled the trade by selling 1/3 at 2 times where my new stop loss is. And I only had to push my stop loss up from here to here when the trade was then playing out for me to free roll it. And I'm still giving it room. So do you want to be Jack Trader A, who has open risk of 4.38%, but has their entire position, or do you want to be Jack Trader B, who has 2/3 but now has no risk on the trade? I know which trader I want to be every single day of the week. First solar. So here's one. You guys who are trading around this time will know we're heading into the FOMC meeting, which was likely to create a lot of volatility. So instead of selling a third here, I took the opportunity and went, I could sell a half here. Now, ideally, if we didn't have kind of the significant event of the FOMC, this was the October. It was October-November press conference. I think it was either first couple of days. I think it was Wednesday. Wednesday, the 2nd of November rings a bell. But either way, my objective with all of my current positions at this time was I want all of them free rolled heading into the FOMC meeting. Position myself beyond the possibility of defeat, because the last couple of FOMC meetings the market had sold off hard, that there is likely to have a negative effect on the stock. So I'm thinking risk best, right? So here, instead of waiting till 1/3 of 2 times my stop loss, I decided to go half at 1R. Again, it's the market playing out in front of you. There was a significant event coming up. I'm taking half off 1R, free rolled it. So then if I get stopped out down here, I do not have a loss of 5.5%, 6%. Okay, I'm break even on the trade. Then it closed below the 10 EMA here, so I took off a quarter. Usually I would sell 1/3 at 2R, and then a third on a close below the 10 EMA, then a third on a close below the 21 EMA. But now I'm just going quarter because I sold a half there. Dice, this is a biotech stock. So this stock here, it starts moving out on this day in here. So what do? I go, it's a volatile biotech stock. I now have an opportunity to free roll the trade. So what I do is I sell 1/3 in there. I push my stop loss up below the low of this bar, this little demand tail that comes through, still underneath the pivot, still underneath the 1021 EMA. Now free rolled it instead of having risk on the trade of nearly 6%. Free rolled the trade. It's now getting out. Great. Can I sit through the first testing action and then try and play it for a bigger intermediate term trend? TMDX. Okay, so my entry is here, it's coming out of a cup and handle. This is a medical product stock, triple digit earnings for the last couple of quarters, really strong stock. So I take it here. It takes a couple of days. Initial stop loss is about 5%. Place underneath these recent lows. Then on this day here, I sell 1/3. Okay, at 69.7, I sell 1/3 in here, simultaneously then pushing my stop loss up here. Why? Because the trade is adapting. I have an opportunity in what is still a tricky market environment to free roll the trade. I'm going to take that every single day of the week. So I now free roll it here, stop loss is there. Can I sit for a little bit of testing action, then try and play the stock for a bigger intermediate term trend? But I'm now there risk free. So my whole kind of process is built. How can I quickly get to a position where I'm risk free on the trade, then see if the intermediate term trend can play out? So it's identify, control, mitigate, optimize. PCVX. So this is an example of risk mitigation in action. So this is a high tight flag biotech stock. Nice shakeout, starts getting tight. So I enter it here, takes a couple of days to go, but on this day here, it starts getting out. Okay, the gain here, just play this one forward. The gain here is around about 7% roughly. That is enough for me to sell 1/3 at 2 times where my initial stop loss is in this case, because my initial stop was tighter in this instance, around about 3%. So I sell 1/3 there. I can maintain where my stop loss is here. Now I'm there risk free, so I don't have 3% open risk. I'm break even on the trade. So if price comes back down here, I'm break even instead of taking a 3% loss. So that there is how I like to position myself beyond the possibility of defeat with all of the positions that I take. My first objective is number 1, identify it. Number 2, control the risk. Number 3, mitigate that risk. And then number 4 is try and optimize the profits if the stock is right, if the market is right, for allowing those intermediate term trends to play out, which I never know ahead of time. So thank you very much for watching. If you made it to the end of this, if you made it to the end of this video, as always, look forward to seeing you in the next one.